Hi everybody, welcome back to the channel. Hope everybody had a great Thanksgiving. And we are talking today about the ProShares S&P 500 High Income ETF, otherwise known as ISPY with my little I, some monthly dividends. We're going to be making monthly dividends from this ETF, which I love. And monthly dividends get me really excited because the idea of earning these dividends by doing absolutely nothing but putting money into this ETF and then it spits out, so let's say 7 to 10% per year is pretty exciting to think about, right? So you can always diversify into these ETFs and other types of ETFs depending on your risk tolerance, investing goals. My long-term vision is kind of to build various ETFs, but also to do the wheel strategy myself against certain dividend stocks and to have like that blue chip dividend portfolio spitting out the dividends while also trying to do some covered calls, right? So you can kind of divide it up into different segments or buckets, and you can do this across the board with these types of ETFs. So this one right here, which came out in 2023, as you can see, it's up 13% since basically inception. It was at $40, now it's at $45. So not quite as good as the market. We know the market's been on a tear. We know that everything's been going parabolic. Lots of stuff has been going up. Let's just say that the small caps have kind of seen a resurgence recently. And if we're looking at the S&P 500, which this is based upon, you can kind of compare this to the S&P 500. Now, over the last year, this looks like about, 15%. If we look at the S&P 500 or the SPY, if we just take a look at that, 32%. But keep in mind, this is an ETF that is focused on income. And if we look at the yield right now, the ProShares S&P 500 High Income ETF, ISPY, 7.84 is the dividend yield. And that's based upon this annual dividend. They simply divide that by the price. So depending on how you specifically calculate the dividends and over what period, maybe you'll get a different yield. I think if we go over to FinViz, it'll tell us that it's paying, a 9% yield, which is over $4 per share. That's what they're basing it upon. But if you look at the chart on FinViz, you can kind of see how just over the last year, you can see each dividend being paid out. You can see exactly how much it's been paying out. So we had a 31-cent dividend, a 35-cent dividend, 31 cents, but kind of consistent within that 30 to 40 cents. Some 62 cents was really nice back in September. That really probably helped out the yield. But if we go back to ISPY, the page from ProShares' website, you can see how it goes over the fact that this is a daily call option strategy against the S&P 500. So SPY and all these ETFs, if you look at them, they actually pretty much allow you to do daily options. So there's like all these expirations you can choose from. And so I'm wondering, and I haven't really looked into it or deep dived this enough to see exactly how they're doing it, but just know that this is a daily call option strategy against the S&P 500. So I think the idea here, if we look at what this is actually, we can just kind of read what this says. ISPY is powered by a daily call options or covered call strategy that offers high income potential. Selling call options each day can produce a high level of income, and we also get efficient income generation. So we're seeking income that target the S&P 500 returns over the long term. So even though over the last year we have not quite gained as much as the S&P 500, we're still spitting out the dividends. And so depending on how you look at it, if you're reinvesting the dividends, then you probably are keeping pace pretty close to the S&P 500. But always remember with these covered call ETFs, you're most likely not going, and I shouldn't say even most likely, pretty much if you look at any of these covered call ETFs, they underperform the index they're tracking. And the reason for that is simple. Your upside is capped, because you're selling covered calls. And so anytime you're selling a covered call, you're only going to get up to the strike price of gains. But the idea is if the options expire worthless 8 out of 10 times, if you have a 20 delta or 0.20 delta, meaning 80% of the time the options or covered calls will expire worthless, then perhaps this could be a viable strategy. And so it's kind of like going to the casino. You have the buyer of the option who's expecting a big move in the price, and you as the seller of the option are simply trying to collect a consistent income stream. So that's kind of the idea here, except they're doing this on a daily basis, which is pretty interesting. And if we look at higher return potential, we're seeking to capture returns that, monthly covered call strategies may sacrifice. And so they're looking to basically take advantage of, I think time decay is going to be the main one they're looking at here. So if you think about theta decay, on the last day before expiration, if you look at a SPY option, By the time that option is, close to the market closing at 2:45 p.m., the market's almost closed, so that option's going to practically have no value. So over the course of that day, assuming the price has not allowed that option to go in the money, meaning it has no intrinsic value, the only thing left is time value. And so what you would likely see is the call option basically deteriorate. And so that's kind of, I think, what they're going for here. If we look at the ProShares S&P 500 High Income ETF seeks investment results before fees and expenses that track the performance of the S&P 500 Daily Covered Call Index. So we're gaining exposure to the sale of daily call options using swap agreements and does not trade options. So that helps clarify things there. Okay, so, and by the way, I just learned about this today, so I'm just going over this as we discuss it together. This is actually, I'd never even heard of this ETF until I did a quick, I think I may have saw an ad earlier actually that triggered this. So $10,000 back in 2023 is now worth $12,500. So we have the chart there. You can look at the total return numbers about the fund. It tells you the expense ratio, 0.55% for the world's first daily covered call ETF. Not bad, okay? Not bad. 0.55, anything less than 1% on ETFs is kind of what I look for. Ideally, we're under half a percentage point on the expense ratio. If you look at a Vanguard ETF, you're going to be under 1/10 of 1%. 10 basis points is going to be the standard, if not less, right? 6 basis points, which is 6/100ths of 1%, right? So now we're getting really small versus a 0.55, so we're over half a percent. Not terrible. But not great either for the expense ratio. Average market cap, 100 billion. So I guess this is going over the, if you look at the number of companies it's invested in, you have the distributions, the annualized distribution rate. You can see the SEC 30-day yield distribution rate represents the annualized yield based upon the last income distribution. So if we're just assuming that, if you look at the SEC 30-day yield, it's a standard yield calculation developed by this SEC that facilitates fair comparisons of funds. So it's basically the dividend and interest that's been earned by what's been held in the fund over the last 30-day period, less the fund's expenses. So you're taking that 0.55 expense ratio on a monthly basis and subtracting it from whatever they're receiving in terms of the dividends. If we look at the net asset value, 45.72, we already went over that. Now we can kind of get into the exposures and which weightings you have. So 32% information technology, financials, definitely preference for healthcare, all those kind of markets that are expected to keep on going up. I think, finance, healthcare with AI and everything, information technology, probably all good sectors to be in. You have utilities at 2%, real estate at 2%. You have different positions in terms of, you also have the holdings here. So the actual holdings, you have the options. There's an option right there, it looks like. So this looks like probably the swap agreement they were talking about. S&P 500 Daily Covered Call Index, call only, swap Goldman Sachs International. So they're doing a swap contract. Exposure, it shows you the exposure of what this is, and then it shows you also the weight of, it looks like all the positions in the stocks that it owns here. It shows you everything there. So this is definitely interesting. It kind of just is interesting to deep dive this to kind of see how this fund works, because it does say it's the world's first daily call option strategy. So I've seen the weekly ones and I've seen the monthly ones. This is the first daily one. Now, what would be interesting is if they make an ETF that does this or something similar but actually pays out daily. Now, that would be something to see if you had a daily paying ETF, right? We have monthly paying ETFs. I've seen weekly paying ETFs. This one pays on a monthly basis. But, here's the most recent dividends once again. The 62-cent dividend, pretty much, that was paid out November 10th. So that would have been a very nice dividend. 26 cents. You see it's very, fluctuates based upon how much they can make from these covered calls and these swap agreements. But nonetheless, not a bad yield, 7.84%. I spy with my little eye. The ProShares S&P 500 High Income ETF. You can earn monthly dividends, and you can also participate in some of the upside of the S&P 500. So ISPY stock or ETF, you just put the I in front of the SPY itself, and you can kind of compare the two indexes and how they're performing. But remember, with this, you always want to factor in the dividends. If you're taking those dividends out or reinvesting, that's going to make a huge difference in terms of the total returns. So you may be underperforming if you're not investing the dividends, but nonetheless, you can still earn the regular income. When I worked at Charles Schwab, I used to talk to a lot of people. One of the guys I remember, he was invested in JEPQ, which I've discussed on the channel, and some other ETFs, and he was basically just earning the monthly income from that and basically was retired. I think he had about a $500,000 portfolio, but nonetheless, it's possible, right? So these monthly dividend ETFs can definitely come in handy when it comes to doing this type of stuff. And with that being said, thank you all for tuning in. Hope you all have a great Christmas if we don't talk again. I have a feeling I'll probably make another video before then. But I hope you guys enjoyed this video as always. Let me know what you think in the comments down below. And we will see you in the next one. Take care.